All right, Kyle, let's get into this. Let's talk about cash damming and why that strategy is maybe often overlooked, or let's dig into it. And really, the idea that we wanted to share here is to build off the same thinking as the Smith maneuver. We've got 4 episodes on the Smith maneuver. We have episode 44, 81, 87. All around the Smith maneuver and how you can write off, say, interest expense against, say, technically against your mortgage. And so it's kind of like we've talked about that one so much because it's a secret sauce type episode or a secret sauce type idea that helps you save in taxes, puts a little bit more money into your pocket, or allows you to kind of use it towards some other things. So that idea we've shared a lot here, but this idea around cash damming is very, very similar. Let's dig into it. Give us the lowdown. What is it, and what are we talking about here?
Absolutely. This is another debt strategy that, we're trying to get people comfortable with the idea of debt and what we like to call good debt, right? And with those Smith maneuver episodes, so we did 4. Why? Because we had such a positive response. So many people were intrigued and interested to really dig in. A lot of people have heard of the Smith maneuver before, but there was a lot of uncertainty around it. There was a lot of misunderstandings about it. And today, cash damming is something that those who are in, we'll call the Smith maneuver camp, also tend to employ, but it's slightly different. It's for the same purpose. It's this purpose of paying down your primary mortgage and opening up a non-primary borrowing vehicle, typically a line of credit, where you can then write off the interest. So right off the starting point here and off the starting blocks, a lot of people get confused with the Smith maneuver and with a lot of other debt strategies as a way to pay down debt sooner. That's actually not the intended result of the Smith maneuver. It's about taking whatever you owe now on your home and then slowly converting it into what we call tax-deductible debt. And therefore, the net result is the same amount of debt technically. Some people would even allow that debt to grow by actually compounding the interest if they're investing. So the same is going to be true here. We're talking about a debt strategy that's not actually going to be used to pay off debt sooner, but rather to convert that debt, that non-tax deductible interest, into tax deductible interest. Right. And the goal is, if you think about this, if we zoom out a little bit and you think about where you hope to be later, and I would argue most people want this more than, say, staying the same, is that they hope to be earning more income in the future than they're earning now. So why that matters is because if we have tax deductible interest, what we're able to do is we're able to funnel more dollars towards growth assets. And that also typically means more taxable income. Why that's helpful here is because if we have tax deductible interest on money we've borrowed, we can then write it off against that high income that you tend to be growing over time. So typically, the wealthier you get, the higher your tax bracket becomes, specifically for those who aren't actually thinking strategically about this work. And that's where this and today's discussion is going to dig in. We're going to look at a Smith maneuver-like approach for business owners who are not incorporated. Okay, those who are incorporated, we have something for you at the end that you can consider. But for those who are not incorporated, so these are people who are sole proprietors, or maybe they own rental properties or investments at a personal level. This is a way that you can actually kind of swap some of that mortgage that is non-tax deductible, that interest that's non-tax deductible, into Smith maneuver-like tax deductible interest by simply changing the flow of money a little bit here.
Yeah. And so let's, because you're saying like, I wanted to make sure we got that in there. Like we own properties in our personal name, but we also own properties in our, say, corporations. And which is, so it's like just because I have a corporation doesn't mean I can't use this strategy for, say, the assets that I own personally. So let's unpack the differences here. You outlined the idea of the Smith maneuver. We've got those 4 episodes on that. Specifically, what's the difference here? Because the Smith maneuver, in my respect right here, is the Smith maneuver. We are always kind of thinking personally, I can do this. Now, since we're still on the personal side, what is the difference between the Smith maneuver and cash damming?
Yeah, I love it. I love it. So Smith maneuver is really, the idea is the dollars that you were going to be investing in something. It's up to you what the asset class is. Those dollars, what we're going to do is we're going to funnel them towards your mortgage. You're going to essentially make an overpayment to your mortgage and open up some home equity line of credit room. And then you're going to borrow that money back and then put it into the investment. So it's still a pass-through like structure here, that we're just getting $1 to funnel to your mortgage, paying $1 off of your mortgage, opening up $1 of home equity line of credit room. You're going to borrow that same dollar back and put it into the market. And essentially what you've got, the result you have is that, hey, if you owed $100,000 on a mortgage, you now owe $1 less on your mortgage, but you've gained $1 of debt on your home equity line of credit. And obviously that's scalable, $1,000, $10,000, whatever the number is that you want to do here. When we talk about cash damming, what we're actually doing is we're doing a similar philosophy, except instead of this being $1 that's going to come in and go into an investment itself, it's actually $1 that was earned from your business or your investment. So that's your rental property. If you're an unincorporated physician, if you're an unincorporated business owner of any type, you're earning this money. And that money, some of this money was going to go towards paying down expenses, right? You have all of these overhead costs that you pay every single month. It might be for the employees that are working for you. It might be for the building you're renting. It might be for any other type of business or investment expense. That dollar was going to pay off that expense. Well, instead, we're going to do the same thing here. We're going to take this dollar and we're going to put it through the mortgage first. This is your primary home mortgage where interest is not tax deductible. It's going to bring the debt on your mortgage down by that dollar, and you're going to borrow it back from the home equity line of credit or whatever line of credit you want. It's totally up to you. You borrow that dollar back. Your net debt owing is the same, but now you have $1 of tax deductible debt. That debt, when it pays interest, when you pay interest on that dollar, you're now going to be able to write off that interest amount because we borrowed that money back in order to put it back into the business or into investments. And there is a goal of earning income. And that's essentially what the Income Tax Act is telling you, is saying, listen, if you're borrowing money in order to make money through business or investment, then you can write off the interest. So we really have the same exact strategy, except one was $1 that was going to go straight into investments. The other one was $1 that was going to pay off expenses in the business anyway. It was money that was going out the window anyway.
Yeah. So it's like when you said, because what you're doing is you have to pay expenses anyway. And what you're saying is take a chunk of money, put it in the mortgage first instead of paying your expenses. Like normally we just be like, I'm going to pay expenses every month. And then I would take what's left and maybe do something with that. You're saying pass it to the mortgage first. It's kind of like the pay yourself first model that we talked about a long time ago. It's like that similar idea. It's like instead of subtracting expenses to get your profit, subtract, figure out that part first. It's almost like put it on your mortgage. Now borrow it back to pay the expenses afterwards.
100%.
And then now, so now you've got that, you deduct that because you borrowed that for, say, business expenses. Okay. It makes sense to me. Now, Kyle, this is the part I think, right? Like, and this is the same idea with the Smith maneuver. And the difference between the Smith maneuver, I think, was why I say maybe more people are using this is because you can see that if I borrow this money off my line of credit and invest, I'm going to make I'm going to use that interest rate advantage, and it's going to I got to pay interest on the borrowed amount, but I'm going to make more money on the investment, and therefore I can feel like mathematically this makes sense to me. Now, if I'm going to borrow the money for my expenses, isn't it just more expenses? Like, tell me more about that. It's because I'm going to borrow the money for expenses. Like, yep, I'm creating this taxable or this reduction in the amount of tax that I'm going to pay because I'm borrowing this. I have this tax deduction I can claim, but I also have to pay the interest for that year.
100%. So this is the part in Smith maneuver. This is often missed. We've said it in 4 episodes and we're saying it in a 5th one. With the Smith maneuver, a lot of people forget the fact that it's like your debt hasn't gone down. Like you still haven't paid debt down. And in the kind of perfect world of the Smith maneuver, you'd actually never pay that debt down because that deductibility is so valuable to you later when you're taking income, right? So this idea is that basically if you're a Smith maneuver advocate as it is sort of designed, if you're like, yep, I'm going to do that and I'm all in, you have to be comfortable with this idea that that mortgage number is going to go down, but your actual overall debt owing on your home is the same. So you actually are being comfortable that, you know what, because rationally this makes sense, I'm going to grow investments and I'm going to keep this debt and my net worth is going to be higher. You're actually saying, I'm going to play the game to win. I'm not just going to play the game to feel good about myself, which is like pay that debt off, right? Instead of investing. With cash damming though, this is a little bit harder. And this is where it becomes a better and a more specific individual. And you really have to do an analysis to figure out, does this work for you? Because it's not like easy out of the bag. I would say it's hard to find someone where the Smith maneuver doesn't make sense simply because you are borrowing money to make an investment, right? So like that part makes a ton of sense. So unless the interest rates are so far apart on the home equity line of credit and on the actual mortgage, unless it's like extreme, you're likely going to be much, much better ahead. Whereas with cash damming, that's not necessarily true. And I'm going to talk about the main concern that we have to think about here is that you have expenses in your business or from your rental property or whatever this income is being generated by. And that bucket of money was going to be allotted towards paying down what you planned for, these certain expenses that you have. And that's fine. But if I take that money and I put it onto my mortgage and then borrow it back on the line of credit, and the arbitrage between those two interest rates doesn't actually give you a positive result, you could actually be putting yourself in a worse spot. Now, what do I mean by that? Okay, there's 2 ways this can happen. One way is that the actual interest rates are too far apart, I should say, just like with the Smith maneuver. But the reality is that here it's more important because there is no upside in terms of investment. Right? Your business is going to operate as it would with or without this strategy. So it's not like your business is necessarily going to grow by you doing cash damming. What you're trying to do is you're trying to say, listen, if I'm borrowing at, let's say, 7%, all right, on the home equity line of credit, and my mortgage was 5%, all right, I need to make sure that my tax deduction is going to make it seem like I'm paying less than 5% on my traditional mortgage for this to make sense. Now, I'm going to give a really easy example, okay? If you're in a 50% tax bracket, your marginal rate is at the 50% level-ish, and you're going to borrow against your home equity line of credit at, say, 7%. You're going to save half of that money in interest because you're going to get the write-off. You're going to get that 50% tax chunk back. It's like you're borrowing at 3.5%. So in order for that to make sense for you as a cash dammer, you need to make sure that your mortgage amount isn't actually lower than 3.5% in that specific case. Because if it is, then it's actually costing you more money in this particular case than it's worth. And the opposite would be true as well, is that, hey, listen, if we're in a low tax bracket already, if I'm in the highest tax bracket I'm in is, say, 30%, right? Now I have to think about this and say, listen, I can only shave 30% off my borrowing rate on my home equity line of credit to really try to figure out, does it make sense for me to do cash damming? Now, I'll use me as an example. Right now, and again, total luck here, but I'm at under 2% on my personal primary residence fixed until December 2025. So that under 2% is a really tough one for me to beat if I want to use cash damming. So at this time, cash damming doesn't actually make sense for me in my situation. Whereas the Smith maneuver can still potentially make sense because I am going to make investments. And I do know that I only have that low interest rate for this next year or so, right? So it's like 1 year of benefit. And then guess what? My fixed rate's going to pop back up and I'm probably going to be in good shape again. With cash damming, you've just got to make sure that, hey, if I'm going to do this, am I in a high enough tax bracket at a personal level where I'm going to benefit from this work, right? Because it is effort. I've got to funnel this money through the mortgage. I got to borrow it back. And then I also have to take on potentially the emotional strain, knowing that there is debt there, right? That there is debt. And I want to know that and feel confident that by using this strategy, it's actually going to give me a net positive result most years.
Yeah. And let's talk about the, because we preface this with, this is for non-incorporated business owners. And again, it's just because you maybe own an asset, say a rental property or have income or a business that's not incorporated. You're that sole proprietor. This makes sense because of your personal mortgage and making it tax deductible. Now, if I'm a business owner that I'm incorporated and you're thinking like, can I do this here? Like why can't I, like, let's say if I have a mortgage in the business's name, why can't I say do something similar here? And the idea here is that your business, because you're saying own a mortgage in the business's name, the business's interest is already tax deductible. It's a business expense because it's owned by the business. So you're not saving on, say, that deduction that you would be personally and all, but you can still do it. It's just all you're doing is like, for example, you could still go like, I want to pay less interest on my mortgage as a business owner. So what I can do is put all it's almost like that pay yourself first strategy. I'm going to take all my revenue or a bunch of my revenue. I'm going to pay it down to the mortgage. That's going to reduce the interest that I'm paying on the mortgage. And then I can use my line of credit to pay any expenses out when I have those expenses. And all you're doing, as what Kyle said is before, is you're really swapping that debt. You're not really saving any, say, tax because it's already, it's already a deductible. On that. So that's the way you want to think about it. If you're already an incorporated business owner, it doesn't help you anymore. The idea still can be helpful as long as you're okay with swapping that debt.
Yeah. And something I guess to think about is like, if you know that some of these expenses, it's like you keep money there because this quarter you have certain expenses coming up, or this half of the year, or this year I have certain expenses. By doing that, what you're doing is you're basically saving the overall balance of money owing while that money's sitting there in that account doing nothing, right? So if you have I talk to business owners all the time. They keep 100,000, 200,000 sometimes sitting in a bank account because they know that anything can happen, right? So for some of those people, if they know that they don't want to take that money and put it into, say, long-term asset, one thing they could do is they could put it right into, say, some of the debt that they might have in the business. It could be the mortgage on the building, the this, the that. As long as they have that credit facility that they're able to borrow back when the time comes. But the challenge that you run into playing that game is that, listen, if the rate is high, right, which a line of credit, the rate may be high, you're not actually arbitraging on tax savings at all. It's more just playing the game of like, how much more can I put over here to save some interest,
right,
so that I'm not borrowing too much from the line of credit? Because if it ends up being a complete debt swap, you're going to likely be behind. You probably have a cheaper rate at the fixed rate against a building or against a piece of equipment or whatever it is you have than to be pulling from the line of credit. So I might argue for those business owners who are thinking about a strategy like this, they're like, I've got money sitting and it's there. It's like my quote unquote emergency fund, and or it's money that I know that sometime in the future I may have to lean on, especially if maybe revenue's light in this year, right? It's this arbitrage game. So what I recommend for some of those business owners is that they actually start a small permanent policy inside the corporation. They own it, corporately owned, because it's so liquid. So it can earn money, no passive income tax on the cash value it's growing, and then they can actually leverage against when they do need to lean on some of those funds. And I say when. So if they know they're using it later this month, probably not the best move. But if they've got, like, I call it the war chest, the under the corporate mattress, stash of cash, kind of doing nothing or earning very low rates in a savings account and then getting taxed at 50% of it passive income, could be a good idea to actually, instead of funneling it onto a building's mortgage, because again, probably favorable interest rate there, and then having to borrow back against the line of credit, you could actually build it into, say, a policy, which is going to give you a much better long-term result. You've got the cash value growth. It will continue to compound even if you leverage against it for whatever these expenses or these unexpected expenses might be. And then you also get this wonderful death benefit that sort of helps to take care of your estate planning because of the capital dividend account, where the net death benefit will actually pay out down the road. So kind of solves many problems while you're not just letting that money sort of sit there and sort of inflate away in a savings or a checking account.
Yeah, and one of the added bonuses there too is you said it's liquid, but it's also not, because especially if you use the policy loan, it's contractually obligated for the insurance company to say, earmark a chunk of money for you to borrow against that policy. Like, you just say, hey, where do I want this money? They just say, what, I want it in this bank account. A couple of days later, it's going to be there. You don't have to go ask for permission. Now, if you already if you didn't have a line of credit, set up, you have to go get approved. You have to make sure that you get all this paperwork and sign, and all of a sudden things kind of balloon up a little bit like that. And you don't have to do that with your policy. The other thing is, all of a sudden, let's say your mortgage refinances, and now all of a sudden you have to kind of decide, what are you going to do there? And maybe the qualifications are different at that point. The interest rates are different at that point. You don't have to worry about that if you're going to go the policy route. It's completely liquid to borrow in that emergency fund or borrow in that way. It's true whether you're a business owner or say you own a policy in your personal name as well. This is not, say, just a business owner. Now, Kyle, I think we wanted to specifically talk about cash damming is in addition to the Smith maneuver as just another example of why, how to use tools at your disposal to optimize your tax implications and put more money in your pocket, those secret sauces. That's what we talk about here in the show, right? Is what are the secret sauces? And what I love about the tools here is making sure, or thinking about, how do I use debt appropriately, good debt, and how do I make sure I'm okay and mentally okay, and emotionally okay with using debt as a tool? Because if I can get my mind wrapped around that debt can be used in a good way to benefit myself and benefit my corporations, then I'm almost in a way home free. It's I as soon as you learn and feel comfortable there, options open up. But if you're I'm not there yet, I feel like all debt is just eating away at me, or I'm not going to sleep at night if I have this, then you may be missing out a little bit, because you can be strategic. You can use the numbers in your favor, because there are some logical reasons to be using the debt to help create these opportunities for you. And that's why we want to share them here on this podcast, is to help think about why you can use debt to help build up your wealth, how you can do that. What are the options here? We want to give you a glimpse about cash damming today.
Yeah, the big piece here is that debt is definitely something that we have learned to become afraid of, right? And I think for good reason. Again, if you're irresponsible with debt, if it's bad debt, if it's it's interesting, and I find it slightly ironic that we've been trained to be okay with massive amounts of debt on depreciating things, right? So, for example, to buy a new vehicle, for example, people are buying cars and SUVs and trucks for over $100,000. And for some reason, we're okay with that debt, even though that vehicle will eventually end up in a landfill. It's not going to grow in value. And yet we have been sort of trained so inappropriately to think that debt against assets is like a no-go. Like that's risky, right? And in reality, it's quite the opposite. The idea that really people struggle with when they get to their retirement or their financial freedom years is this idea that they've planned with an accumulation strategy and the implied decumulation strategy. I say implied because no one really addresses it. But the problem becomes is that unless you've accumulated enough income or enough assets, I should say, where you can live off of the growth, that number is going to actually slowly decrease. And I say slowly, it can be fast if you're spending a lot of money. And the problem is when you start pulling money from assets and that decumulation strategy where you're trading in assets to live, you lose the compound effect of that large pile of assets, right? Whereas when we leverage against that pile of assets, you get to continue compounding this really large number, this really large value over each and every year while you borrow up to that amount. And the reality is that if that pile is growing at anywhere close to the equivalent rate at which you're borrowing, right, which generally is the case with assets, with most assets, you can be very conservative and still be outpacing the quote unquote rate of interest you might be paying on that debt. So in today's episode, what we're hoping you'll get is this idea of starting to, we'll call it mend your relationship with debt and start thinking about how can I use debt more in my favor so that I end up net ahead instead of following the typical debt advice, which is to essentially use it in the worst possible scenarios, buying new vehicles and, financing all of these depreciating things that make us feel good in the moment. Mm-hmm. The reality is we should actually be saving our use for debt against assets so that we can actually live a better lifestyle. We can pay less tax because, hey, on debt, there is no income tax, and be able to allow those assets to continue growing in the future. So we actually don't get this perspective or this thought that, oh my gosh, all of this hard work I've worked my entire life to build is now sort of depleting away and making you feel as though, you're in worse shape than you were when you first started. So if any of this is intriguing to you, and if you are an incorporated business owner, or maybe you're not incorporated, but you have a significant amount of personal assets, we encourage you to reach out to us for a discovery call so we can discuss some of the strategies that might be available to you. Reach out over at CanadianWealthSecrets.com/discovery, and we can hop on a discovery call so we can get you optimized so that you can maximize the use of your assets and be introduced to some interesting strategies that will mean paying less tax and simply having a better financial future.